Now let's come to the next part called partners loan. Now this is one of a very interesting component of a partner who has to be repaid when he is retired. Hey Girija, right? When a partner is retiring, it's our duty to make sure that we pay them the money. If we are not paying him the money, what happens is you become liable to pay him the interest. You become liable to pay him what? The interest. So we look into it in that case. See here, retiring partners loan. Let's see this question. This anyway has hardly been asked in your exam, but we'll still look into it. A partner's loan stands at 30,000. It has to be paid in 4 equal installments, and the loan is to carry 6% interest. So this guy is having what? 30,000. You have to pay him what? In 4 installments. That means, can I say that every time you would be paying 7,500? Correct? Now they are saying that this interest should be carrying 6% interest. So when I'm saying the loan has to carry a 6% interest, what we would be looking at it is we will be looking at 6% of the outstanding amount. So you'll be paying not only 7,500 but also the interest portion of the loan. But also the interest portion of the loan. Are you clear till now? So when you're doing the partner's capital account, see here, you always wrote the partner's loan. See in any of the question, you have always written the partner's loan towards the credit side. Towards which side? Towards the credit side. So what happens with this is when I'm doing the partner's loan account, the partner's loan account is going to be appearing on my debit side. So whatever I write it on the credit side in my partner's capital account, here it's going to appear on my debit side. So here I would be writing it as by capital account 30,000. Clear? Along with this, see first year, what is the interest of 30% plus 6%? The 6% interest for 30% comes to 1,800, right? In the year 1, he will be paying him 7,500 and 1,800. Are you guys clear how I got the amount? That is 30,000 in 4 equal installments, 7,500, and interest on 6%, which comes to 1,800. So he should be paying him 9,300 rupees. Yes, all installments, you will be paying the interest on the outstanding amount, Nidhi. Not on the installment amount, but on the outstanding amount. So guys, see here, see the working note. First year, I have 30,000. I am going to pay 7,500 towards principal and interest 1,800. So total I'll be paying 9,300. Correct? Second year, out of 30,000, if I've already paid 30, out of 30,000, if I've already paid 7,500, what is the outstanding amount? The outstanding amount is going to be 22,500. On this 22,500, you will be paying interest. What is going to be 6% of 22,500 into 0.06, which is 7,500 plus 1,350. Next one, outstanding. Outstanding. Out of 22,500, you have paid what? 7,500. 15,000, right? 15,000, 6% interest on it. So 7,500, 6% comes to 900. So totally you will be paying 7,500 plus 900, 8,400. Are you all clear with the amounts? The last amount is going to be out of 15,000, you are paid 7,500, left with 7,500. So 6% of it comes to 7,500 plus 450, that is 7950. Did you all understand the calculation of interest portion? So every time you calculate your interest, see here, first year interest, interest, right? That's 1,800 interest, whatever I pay is going to come on my credits. So see here, first year 30,000 is the outstanding amount. I will credit with interest 1,800. Then I will be making a payment of 7,500 plus 1,800, which comes to 9,300. Are you clear? Next year, see here, 22,500 is the outstanding amount, and you would be paying 1,350 interest. Mohit, you have to calculate interest. For the partner, you will be paying the interest and the principal portion. So for his outstanding balance every time, for the outstanding balance every time, you add the interest and then you pay along with it. Clear with all of this? Karthik, in the last year, see here, I have 7,500 balance. The interest on 7,500 is going to be 4,950. Okay. This is the next question, illustration number 6. Did we give illustration number 6 as homework or? Okay, we'll do illustration number 6 and then we'll move to joint life policy. Joint life policy is something which is going to be common between retirement and death. So let's look into this illustration number 6. MX is a partnership firm with partners A, B, and C sharing profits and losses in the ratio of 3:2:5. So old profit sharing ratio 3:2:5. The balance sheet is as under. So check whether you have something strange. Capital accounts are there, loans are there, land is there, building is there. So there is no reserve, so I don't have to worry about anything. There is no goodwill for me to write off. Correct? It was mutually agreed that D will retire from the partnership and in his place D will be admitted as a partner from 1st July 2015. That means B will retire, D will take care. we have to check, are the profit sharing ratios are going to be the same. The old profit sharing ratio was 3 to 5. The new profit sharing ratio is 3 is to 4 is to 3. Okay. Goodwill in the firm to be valued at 2 lakhs due to the firm local advantage, and the same will not appear as assets. Whether they give it or not, I don't care. Anyway, I would have written it off. Clear? Buildings are and plant are to be valued at 90% and 85% of the respective balance sheet values. Investments are to be taken over by the retiring partner at 25,000. Trade receivables are to be considered good only to the up to 90% of the balance sheet figure. Balance to be considered bad. In the reconstitution firm, the total capital will be 3 lakhs, which will be contributed A, C, and D in their profit sharing ratio. I think pretty straightforward question. So first thing, what we will do, we'll try finding out what is the old ratio, new ratio, and sacrifice ratio. Guys, everyone start doing it. What's the old ratio, new ratio, and the sacrifice ratio? Old profit sharing ratio, A, B, C, which used to be 3 is to 2 is to 5. New profit sharing ratio is 3 is to 4 is to 3. Sorry, 3, 4, 3. To calculate gain ratio, it is what? New ratio minus the old ratio. For A, the old ratio was 3, 5, 3 by 10. Old ratio was 3 by 10, so there is nothing. For B, he sacrificed 2 by 10. C, old ratio was 4 by, new ratio is 4 by 10. Old ratio is 5 by 10. So B sacrificed 2 by 10 and A sacrificed 1 by 10. D is gaining how much? 3 by 10. Are you all clear? Perfect. Is everyone clear with the sacrifice and gain ratio? How I got Sakshi 3 by 10 is because they've already told the new profit sharing ratio is 3. Here, 3 is to 4 is to 3. Fine. So let's start with the first one. What all have they asked in the question? Let's look into it. They've asked us to make a revaluation account and partners capital account. Pretty straightforward question, so nothing much to break my head on. So everyone do the revaluation account. Buildings to be valued at 90% up. Sorry, valued at 90%. So revaluation account, you will write 2 buildings, 20,000. Then plant and machinery 85,000, 85% to plant and machinery. So plant and machinery value is 3 lakh 80. 15% of it will be 57,000. to bad debts 13,900. So I've covered three things: building, plant and machinery, correct? Now see the investment portion. Investment is taken over at 22,500, whereas the value was 22,000. Therefore, there is an increase in the value of investments. Buy investments 3,000, correct? Therefore, I have a loss. Buy partners capital account A, B, C. The loss amount is what? 87,900. So if I have to divide it in the ratio of 3 to 5, that's going to be 26,370, 17,580, and 43,950. Are you all clear till now? Done. Now let's get into the partners capital account. Now partners capital account, this case is extremely straightforward. There are partners here A, B, C and D. Then again there is A, B, C and D. My opening balance of capital is only between three partners: 1,04,000, 76,000, 1,40,000. There was no reserves. I only had revaluation loss. So I'll write two revaluation loss: 26,370, 17,580, 43,950. Done. Now we have to find out the goodwill value. See here, goodwill value is 2 lakh. Who's the partner who's retiring? Partner who's retiring is B. B's share of goodwill will be 2 by 10. So B's share out of 2 lakh B's share of goodwill is 2 lakh and C is also giving 1/10 share. So C is giving here, B is giving 2 by 10th of his share, C is giving 1 by 10th of his share, D is getting 3/10 share, correct? So out of 2 lakhs here, out of 2 lakh, B's share will be 2 by 10, which is 40,000. C's share is 1 by 10, 60,000, sorry, 20,000. Totally, D is getting 60,000. Are you clear? So the partner who's been getting here, is going to be, I told you, you will be debiting the partner to B and C 60,000 and crediting D 40,000 to B and 20,000 to A. Done. Now they said B is going to get the investments at what? 25,000. Right? B's value 25,000. Now let us try closing the values of B, because you'll be transferring it to loan account, to B's loan. That's the balancing figure, 1,16,000, and here it will be 73,420. Fine. Now they are telling that the capital account balance has to be 3 lakhs. 3 lakhs in the ratio of 3, 4, 3. That means what? This should be 90. This should be 1,20,000, and this should be 90,000. This is the, now from where did I get here? Here they are saying, see here, A and C in the reconstituted firm, they want the capital to be 9 lakhs, which is to be given in the ratio of 3:4:3. So my closing balance of capital should be 3:4:3, which is 90, 1,20,000 and 90. So I'll write two balance carried down. Friends, 90,000. Are you clear? 1,20,000 and 90,000. When you do this, what happens? First time in our partnership account, we are finding our debit to be more than the credit. This would be the money which they bring in through bank. So let's see the total. 90 plus 26, 1,16,370, right? By bank 12,370, that comes to 116,370. Here we anyway closed 1,16,000. Next one 163,950. So when you do the number, the balancing figure becomes 3,950. Then the last one has to be 1,50,000. Are you all clear till now? Mohit, what they are saying is your closing balance has to be 3 lakhs for all the three partners put together. So when you're saying your closing balance has to be 3 lakhs, they want it to be maintained in the profit sharing ratio, which is 3:4:3. If you are maintaining it in the ratio of 3:4:3, right, that comes to 90, 1,20,000 and 90. Okay. So when you put the balancing figure as 90, 1,20,000, there is a mismatch between debit and credit. That mismatch amount, you have to bring it through cash. It clearly mentions in the questions here, which will be the reconstituted firm will be 3 lakhs, which will be contributed by A, B, and C in their profit sharing ratio. That means any difference amount, he has to bring it through cash. Are you all clear till now? Okay, guys, under joint life policy, right? Now we need to understand what is this joint life policy concept all about. For most of the foundation students, what I've seen is they've all struggled with joint life policy because they have never understood what is this joint life policy all about and how does it get treated. I want you guys to get your concept right of joint life policy, so that your examination questions, when it has been given, you can easily approach to say, boss, is it a expense, asset, liability, or anything? As per the question part, we'll look into it. So can we start? What do you mean by joint life policy? Okay. What is joint life policy? A joint life policy is basically an insurance cover taken on the partners by the firm. So what the firm is doing, it is taking a life insurance policy on all the partners. Now what happens is, why do they do this? Let's say if any of a partner dies, or let's say a partner retires, sometimes the firm will take some time to recoup or replace the partner and get back to its original position. Therefore, to make sure that during that time the loss can be sustained on, what they do is they take an insurance on the firm. Now, sometimes the insurance will be taken on the individual partners or on the entire firm. Since partnership firm does not have a single entity, we always take it on the firm's name itself. We always take it on the partner's name. Now, see here, let's say for an example, I am paying 10,000 rupees towards joint life policy. Okay, I am taking 10,000 rupees as joint life policy. Now, what is happening? This 10,000 rupees, what I've paid as my joint life policy, I have three ways of treating it. Either I treat them as expense, or I can treat them as an asset, or I can treat them as the reserve. But the net effect of all the three is the same. What happens to the net effect? It's all the same, right? So as I told you, in case of a partner, right, you need to understand in an insurance policy there are two terms. Term number one called as maturity value. Second one is called as surrender value. Called as what? Surrender value. What is the difference between the maturity value and the surrender value? See, for an example, you have taken an insurance policy of 10,000 on each partner. Okay. You are paying a premium, let's say, of 3,000 rupees. You have taken an insurance of what? 10,000 rupees on each partner, and you have paid an policy amount of what? 3,000 rupees. Now, A dies. A dies. He will get the entire insurance money. When I say E, that is, his representatives will get the entire insurance money, which is 10,000. Whereas the other two partners will get the surrender value. What is the surrender value is, at any point of time, when you go and say, boss, I don't want to wait till the time of the maturity, the insurance company is going to give you the money back. But what are they going to give? It's not going to be the maturity value, but it is going to be something called a surrender value, which will be way too lesser than the maturity value. So let's say 4,000 in this case, right? Only the partner who dies gets the maturity value of the insurance, and the surrender value is for the remaining partners. So in smaller terms, if I have to understand, maturity value is the policy amount of the insurance, whereas the surrender value is basically whenever a partner does not die, he will get only the surrender value of the insurance. Are you clear till now? Are you all clear till now? The difference between maturity value and the surrender value. See, it depends on how the policy gets covered. If it is a single policy which is covering each of them, then it is fine, or else it gets surrendered. Because generally, that's why we use the term joint life policy. That is, you are covering the insurance of all the partners jointly. Sudarshan, I hope it is clear. Nidhi, what basis? I didn't understand your question. Okay. Nidhi, the insurance policy amount, there are somebody called as actuaries. They will tell you what is the policy amount which has to be paid by the partners. So that is how your premiums are calculated. We don't have to worry about how the premium is calculated and all, because we are not learning insurance out here. What we are considered about is what is going to be the policy amount and what is going to be the investment amount. Can we start next? Now, guys, see here, the case number 1, what is happening? You are taking, as I told you guys, there are 3 ways of treating joint life policy. 1, expense. Second one, known as asset. Third one is known as reserve. Okay. So when you pay, see here, whether you are doing expense, asset or reserve, when you pay insurance, what is happening? First thing, money is going out. So you are paying what? Joint life policy, right? So I'll write joint life policy premium account debit to bank account. This is going to be the premium amount every year. Let's say I paid 3,000, that is 1,000 per partner. This is the journal entry for paying the joint life policy amount. Are you clear? Now, what is the case I am doing? I am treating the case as joint life policy as expense. When joint life policy is treated as an expense, we know that as per the rule of nominal account, any expense at the end of the year has to be transferred to profit and loss account. So the journal entry will become transferring JLP to P&L, profit and loss account debit. What's the most important point here? Let's say each partner is covered for 10,000, 10,000 and 10,000. Okay. First year you all paid 3,000. This is what going to be the journal entry. Second year you paid again the same. So the journal entry will repeat, that is JLP account debit to bank 3,000, 3,000. Then profit and loss account debit 3,000 to JLP account 3,000. 2 years passed by, you paid premium. Third year what happened? At the end of the second year, see here, the policy amount was 10,000. Policy amount was what? 10,000. The surrender value was, let's say 4,000, 4,000 and 4,000. Now all of these values are going to be given in the question, so you don't have to break your head. So the surrender value given is what? 4,000, 4,000 and 4,000. Third year beginning, what happened? B died. B died. Okay. When B dies, what will happen? When B dies, what will happen? See here, A will get the policy amount, which is, sorry, surrender value, which is 4,000. B will get what? 10,000. C will get what? 4,000. So totally the firm will receive 18,000. Did you understand this portion? Venkatesh, who will get what? We'll look into it later. Since we are doing retirement, we will try looking into it what each of them get. Right now, I'm only worried about, did you understand what happens? So I only want you guys to understand that in case of retirement, they will be getting the surrender value, not the maturity value. Did you understand this portion? Right? We'll continue further with it. Now, I want you guys to just post your answers. A, B, C. First year, they took an insurance policy of 20,000 on each partner. We are talking of case of retirement, right? First year, they paid 3,000 as premium. That means first year expense was what? 9,000. Second year, again, they paid 3,000 premium. So what is the expense for the second year? 9,000. Yes, for B, we will be getting the maturity value. So I got 9,000 for A as an expense for the first year, 9,000 as an expense for the second year. Now third year, okay, see here, the surrender value was 5,000, 5,000 and 5,000. Kunal, it does not matter what is the premium, what is being paid. Guys, in case of death, we will come back later, Kunal. Just let's understand the retirement first, then we'll move to the death portion. I'm doing the retirement portion. We'll cover all the retirement portions first. I only wanted you guys to understand, in case of death, they get a surrender value. That's the maturity value. In case of retirement, they get a surrender value. How are we treating it? First, I'll cover the case of retirement. Then we'll come back to the case of death. Okay, surrender value is 555. That is 15K. Okay. Now what is happening? B decided to retire. B decided to retire. Now my question is, if B is retiring, will the firm get 60,000 or 15,000? Guys, first the firm should get, is it going to get 60,000 or is it going to get 15,000? Firm is going to get 15,000, right? Now 18,000 what they paid was treated as an expense, right? Therefore, the 15,000 what they get will be treated as a profit. This is the first thing you need to understand. Vishnu, Tanuj, Venkatesh, are you guys clear? If the firm, when they paid premium, 18,000 was considered as an expense, then 15K what they got back shall be considered as profit. Guys, when the firm paid premium every year, right, we treated that premium as expense. We treated that premium as what? Expense. Therefore, when one partner retires, the firm will get surrender value of all the three partners. The firm will get what? Surrender value of all the three partners. When they are getting the surrender value, that is treated as an income. Why income? Because whatever I paid earlier, I treated them as an expense. You all understood this? Yes. So, how do you treat profits among partners? This profit among partners will be treated is, it's going to be divided in their old profit sharing ratio. The way we treat general reserves, right? Any if I have treated, guys, again I'm saying, if in the question they say joint life policy is treated as an expense, that means any amount over and above what I get back from the insurance company, that is 15,000, will be treated as a profit. Profit gets divided to the existing partners in the old profit sharing ratio. Nidhi, Income or profit in this case does not matter because my expense is already transferred to P&L account. So 15 income or profit, both are the same because I won't have expense for that particular year. Can we look into the question? Now, let's see this question. Red, white and black share profits and losses in the ratio 5:3:2. They took a joint life policy of 50,000. So the entire policy of the firm is what? 50,000. A premium is 3,000 is paid annually on 10th June. Okay. Now see here, black retires on 15th April 2015. The surrender value of the policy on 31st December of every year was 2011 nil, 900, 2013, 14, 15, right? So that means, Richard, it's not 15 more what we get only 15,000. Now you'll understand this in this question. See here, guys, first year they paid a premium of 3,000. First year they paid a premium of what? 3,000. If they're paying a premium of 3,000 in the first year, they are saying if let's say any partner decides to retire on the first year, the surrender value will be 0. That means they won't get anything. Second year, see here, first year they paid a premium of 3,000, surrender value was 0. Second year they again paid 3,000, so the total premium paid is what? 6. The surrender value what they get is only 900. Third year he again paid 3,000, surrender value became 2,000 rupees. Fourth year he paid 3,000, so totally this guy has paid 12, but the surrender value continues to be 3,600. You might ask a question saying, sir, why is the surrender value lower? See, I'm trying to cover the risk of your death, not for retiring. We had kept the money to compensate the people who are dying in the firm, not retiring in the firm. So retirement will only give back to you some money. But if some partner dies, we'll give you the entire money. Let's say in the same case, first year you took the policy 30,000. Let's say one of the partner dies. Boss, 50,000 straight into the account. No questions asked. Are you clear? Here you are retiring. That means you are trying to leave the firm. So why should I cover for your losses? I am at least giving you something. Be happy with it. Did you all understand till here? Did you all understand here? So what did I say? See here, guys. Every year, now when is this guy retiring? 15th April. The last surrender value I have is on 31st December 2014. That means from 31st 14 to 31/12/2015, if any partner retires, the firm will get only 3,600. I hope you are clear with this. Now, what did I say the journal entries? Every year, joint life policy account debited to bank account. Correct? And every year end, you have to transfer it to P&L account, that is profit and loss account to JLP. This you will do it first year, second year, third year, fourth year. Fifth year, before I pay itself, B, that is black, decides to retire. Are you clear? When black decides to retire, the firm is getting money. The firm is getting money. If the firm is getting money, what will be the journal entry? Bank account debit 3,600 to JLP account 3,600. Are you clear? This 3,600 what I get is a profit which will be divided in their old profit sharing ratio. What is their old profit sharing ratio? 532. So that is 1,800, 1,080 and 750. So transferring of JLP to the partners will be JLP account debit 3600 because it's a profit to A, B and C, that is 1800, 1080 and 720. Did you understand this? So again I'm telling you, see here, whenever JLP is treated as an expense, every year you pay, you will be having an entry as JLP account debited to bank account and you will transfer to profit and loss. Understood? When you get the money on retirement, remember this, money on retirement will be surrender value, or during the year of surrender you will be passing a journal entry. What is the journal entry you will be passing on is this. During the retirement, the surrender value what you will be passing on is this. That is, first for receiving the money, that will be bank account debit to JLP account. Then whatever money you have received, you will be transferring it to the partner's account, to A, to B, to C in the old profit sharing ratio. In lot of books, they have just eliminated this and they have directly done bank to A, B and C. That's also right. Did you all understand how JLP is treated as an expense? Now everyone understand the second value. Second case is known as JLP is treated as an asset. Now when JLP gets treated as an asset, what happens? Assets will have a closing balance. Assets will have a what? Closing balance. Now remember this, whenever JLP is treated as an asset, right? Your closing balance of the asset should be equal to the surrender value. We will be using the conservatism principle, that is cost or realizable value, whichever is lower. Guys, again I'm saying, whenever you are treating JLP as an asset, remember that all assets should have a closing value and the closing value of the asset should be as per the conservatism principle. And what does conservatism principle say? Cost or market value, whichever is lower. Till here, did you understand? Now I want you guys to see, when you purchase an asset, what will be the journal entry? Guys, when you purchase an asset, what will be the journal entry? Correct? Asset account debited. Let's say 3000, 3000. So whenever I am paying, right, my joint life policy premium, if I am treating it as an asset, the journal entry will become JLP account debit 3000 to cash 3000. Are you clear? JLP account debit 3000 to cash account 3000. Now see in this question, what is the surrender value for the first year? Tell me what is the surrender value. So guys, see that question. First year I paid 3,000. My surrender value was nil. Therefore, I am suffering a loss of 3,000 rupees. Second year again I paid 3,000, but the surrender value was 900. Therefore, I suffered a loss of 2,100 rupees. Third year, see here, third year I have an opening balance of 900. I paid 3,000 more. So my total amount was 3,900. Whereas my surrender value is 2,000. I suffered a loss of 1,900. Last year, I have an opening balance of 2,000. I paid again 3,000. So total value is 5,000. I saw the surrender value was 3,600. So I suffered a loss of 1,400. Should I repeat this again? Guys, did you understand this table or you want me to explain again? Okay, guys, again I'll take the question. See here. Red, black and white shared profits and losses in the ratio of 5:3:2. They took the joint life policy. Guys, we are doing the second case. See, please just remember this logic. When JLP is treated as an asset, I told you there are three ways of treating JLP. If they're saying that JLP should be treated as an asset, then remember that the asset should have a closing balance. We will be using conservatism principle. Under conservatism principle, we are going to be using the investment amount or the surrender value, whichever is lower. Are you fine? Are you guys fine? So asset should always have a closing balance. That's why it's called as an asset. Now, see here. First year, I have paid 1, 2, 3, 4 years, 3,000. Correct? Now see here, first year end, my surrender value was nil. First year end, my surrender value was nil. I paid 3,000. Surrender value, I said asset should be shown at the surrender value. Surrender value is 0. If you are purchasing an asset of 3,000 and if you are suffering at the end of the year, if there is a loss, right, you will be transferring it to P&L account. So there was a loss of entire 3,000 rupees. Second year, I again paid 3,000. The surrender value this time for the second year was what? 900 rupees. So I paid 900. Now, the money what I have, last year's first year's closing balance was 0. This year I added 3,000. So the total amount 0 plus 3,000 is 3,000. I suffered the surrender value as 900. Therefore, I suffered a loss of 2,100. Next year, I have an opening balance of what? 900. I am contributing 3,000 more. Therefore, my value should have been 3,900, right? But the value is saying 2,000. Therefore, I am suffering a loss of 1,900. Last year, I have 3,000. I am suffering 3,000 is what I am contributing. Opening value is 2,000. So the value is, total value is 5,000. I am suffering a loss of what? 5,000 minus 3,600, 1,400 rupees. Did you all understand? Guys, are you clear? Now, see here the way journal entries work. Now, see here, when you pay the insurance, right? See the way your journal entries work. JLP account debited to bank account 3,000, 3,000. That is on the date of payment. End of the year, your journal entry will be first year surrender value was what? 0. Therefore, your loss directly gets transferred to P&L. So it's going to become profit and loss account debit 3,000 to JLP account 3,000. This is going to be more for my year 1. Now year 2, again I'll write JLP to bank. Friends, I will be writing as what? JLP account debited to bank account 3,000, 3,000. After that, what was the closing value? Closing value for the first year was what? 900. Therefore, you suffered a loss of 2,100. So you'll transfer profit and loss account debit to JLP 2,100, 2,100. This is the loss what you are suffering. Now guys, see the journal entry. No, sorry, ledger account. First year, JLP to bank 3,000, 3,000. First year, the entire amount gets transferred to P&L account. Right? Second year, I'll transfer again 3,000, but I'll be transferring only 2,100. So see here guys, it's an asset, therefore I'll have a closing balance. This closing balance becomes the opening balance for the next year. Then you'll transfer 3,000 again. Therefore, I have 3,900. I have what? 3,900. Out of 3,900, this year's closing balance was 2,000. Richard, every year we are paying 3,000, and what you pay as premium cannot be your surrender value. Surrender value will always be lower than the premium amount. Right? See here, then 2,000 is the closing balance. So you'll transfer 2,000 next year, plus you will pay the premium of 3,000. So therefore you have a 5,000 and your closing balance is 3,600. Correct? Now like this you will do. Last year when the partner retires, the journal entry becomes bank to JLP. Now when it is treated as an asset and no partner, guys, see here my fourth year closing balance was 3,600. Partner retired, I got 3,600. So there is no profit or loss to be divided among the partners. Did you all understand? Anshu's here. Guys, I'll do the ledger account again. See here. JLP account. JLP account. First year I pay, it's going to be to bank 3,000. Everything goes to loss because my surrender value is nil. 2 3 by P&L 3,000. Second year again I'll pay to bank 3,000. But my closing value by balance carried down. That is, my closing value is 900. Therefore, I'll transfer the balance to P&L. Done. Third year, see the closing balance becomes opening balance for the next year. 2 balance brought down 900. Then you'll again contribute to bank 3000. So the total value is 3900. Whereas my balancing figure is should be always be surrender value, which is 2000 for the third year. So by profit and loss account 1900. Next, to balance 2000, you'll bring money again to bank 3000. Then you will go with buy balancing figure, which is 3600. So by profit and loss account will become 1400. In the fifth year, guys, see here, I want you guys to just look into it. In the fifth year, you'll write to balance 3600. You sold or you gave up the insurance because the partner retired. So you'll write buy bank 3600. Let's say in this case, instead of 3600, bank paid you 3800. So what will happen? You'll write buy bank 3800. The 200 difference, what is there? You will write buy partners capital in the old profit sharing ratio. You will divide this 200. Did you understand this? So instead of, sorry, it will become 2. So instead of 3600, if I get 3800, the 200 profit will be divided between the partners in the old profit sharing ratio. Are you all clear? No, only the remaining balance gets transferred. Guys, see the last question. Guys, see the 9th illustration. This is typically how your exam questions look. See the illustration number 9. ABC are in partnership, sharing profits and losses equally. The balance sheet of the firm was 31/3/2015 was as follows. Capital accounts are there, pretty straightforward. Trade payables, sundry life. First time we have something called as joint life policy, correct? Now, the moment joint life policy is in the asset side, we know we are talking of the second case. What did I say regarding the second case? Only, let's just focus only on the first case right now. Joint life policy is the only new thing. So let's see what all have they given. A wants to retire, B and agree continue. Joint life policy was taken for 1 lakh and his surrender value was 25,000. I want you guys to tell me what is the value we shall be considering in the books. Okay. Guys, no. I asked you guys a question. Is it, guys, see here, in the balance sheet, they are recording at surrender value. Okay. That is 20,000. On the date of retirement, the surrender value was 25,000. Guys, see here, the balance sheet, when they went to surrender, they would have recorded the previous year value. But when they went in, they are getting 25,000 rupees. So my question was, are we going to be showing or are we going to give back to the partners 20,000 or 25,000? 1 lakh definitely is ruled out because none of the partners expired. The only partner who survived was what? They all retired. So when they retired, See here, 20,000 was the value in the books. They got 25,000. Now I want you guys to ask a question. When an asset worth 20,000 is sold for 25,000, what is the journal entry? Bank account debit 25,000, correct? Bank account debit 25,000 to asset account 20,000 to profit and loss account 5,000. Yes or no? Yes. Now what happens is, here the asset gets replaced with JLP. The asset gets replaced with what? JLP. Did you all understand this entry? Guys, are you all clear? So what happens is, this 5,000, what is profit, gets divided among the partners in the old profit sharing ratio. So we will do profit and loss account debit 5,000 to the partners, let's say A, B and C, in the old profit sharing ratio. Are you clear? Guys, are you all clear? Now let us read the adjustments carefully. A wants to retire, B and C agree to continue the business. So the firm is going to continue. JLP was taken at 1 lakh and 25,000. For the purpose of retirement, goodwill was raised for 1 lakh. For the purpose of A's retirement, goodwill was raised for 1 lakh. So the old profit sharing ratio, sundry assets were revalued for 1 lakh 10, but B and C did not prefer to show such increase in the assets. That means they are talking of what? Memorandum revaluation. That is, first do the revaluation account, profit for all the partners, then loss only for the existing partners. Did you all understand till here? Are you all clear? They agree to bring necessary cash to discharge 50% and the balance 50% to make capital proportionate. I think we know how to do this question, so let's just try it out. So whichever we know, we'll start doing it. So first, what is my OPSR? My old profit sharing ratio was 532. New profit sharing ratio was 2:1. Therefore, sorry, gain ratio is, so A, B, C, 5/10, 3/10, 2/10, then 2/3, 1/3. So what's going to be your sacrifice ratio? Old ratio minus new ratio. That is, for B it will be 2/3 minus 3/10. This is my old OPSR. NPSR. I told you to calculate gain ratio. We'll do NPSR minus OPSR. That is 30, 29, 11/30. For B, for C it will be 1/3 minus 2/10, 10 minus 6/30. So 11:4 is the gain ratio, right? What is the goodwill of the firm? What is the goodwill of the firm? The goodwill of the firm is 1 lakh. A share of goodwill will be 5 by 10 of 1 lakh, which is 50,000, right? Which will be divided between B and C in the ratio 11:4. So 50,000 into 11 divided by 4. 50,000 into 11 divided by 15, sorry, 36667 13333. Did you all understand? Okay, how I decided that I have to do memorandum revaluation account? See here, they are saying B and C did not prefer to show such increase in the assets. That means they want the assets to be back to the original value. Are you guys clear? Next one, let's do the revaluation account. Right, guys, see here, which are the assets which are increasing? The assets which are increasing is only one asset, which is 1,10,000, which is from 80. So first one, fixed assets account debit 30,000 to revaluation 30,000, because this is the assets what has increased. Correct? Is there any other asset which has changed here? Only one asset got increased. So what did I say? This one you have to transfer it to this revaluation. Since it's only one, you will transfer it to all the partners A, B and C in the ratio of 5, 3 and 2. $30,000 into 5 divided by 10. 9,000 and 6,015. Now since I have to do memorandum revaluation, I have to do the reverse of it. That's going to be revaluation to fixed assets 30,000, 30,000. Now this loss should be borne only by what? B and C in their profit sharing ratio, which is 2:1. So that will be B's account, C's account. B's account debit 20,000, C's account debit 10,000 to revaluation 30,000. Are you clear? Did you all understand why memorandum revaluation? Done with the second entry. Now the third entry is for joint life policy, which we already passed. See here. I told you for selling the joint life policy, write down the third entry. Bank account debit. Bank account debit 25,000 to JLP 20,000 to A to B to C, that's going to be 2,500. Guys, if you don't want to do this, you can bring it to P&L account. And guys, are you all clear? Clear with the JLP entry? Guys, did you understand all the three entries? So one was for goodwill, one was for JLP, and one was for the revaluation account. There is no reserve, so nothing else is required. Right? The balance part of the question, you do it. I'll send you the solution. The last topic for the day. Guys, we learned, see here, we learned about JLP. JLP means what? A, B, C, all the three partners, firm is taking one policy covering each of them. Okay, sorry. I erased the first journal entry on the goodwill. The first journal entry was for goodwill. Okay, the first journal entry is for division of goodwill Girija. Goodwill division is going to be 50,000, which has to be divided in the ratio of 11:4. Second entry is for revaluation. Third entry is going to be for JLP account. I hope you guys are clear. See, now the last one is the concept which I was talking about. See, in the firm, generally in JLP, what will happen? All the three partners will be covered under one policy. But if each partner gets covered under separate policy, then each of them get their surrender values. So see in this question, Sona, Gabbu and Amit are partners. Amit retires. So when Amit is retiring, only he gets his share. Other two guys will continue to hold it. Are you guys clear? Are you guys clear with this? Done? Okay. I have uploaded the illustration number 3 and 4. I want you guys to look into it. I'll be sending you guys the questions more for retirement because retirement questions are very often asked in the exam. I want you to solve it. Tomorrow we'll be doing death of a partner. Tomorrow we'll be doing death of a partner. If retirement you have understood, death is extremely easy. There is only one more concept of death, right?